Everybody's asking if we're in a stock market bubble, but the better question is, does it even matter? The data shows that time beats volatility every single time. Long term always wins, and that's not optimism. That's just math, stupid. Are we in a stock market bubble? Well, that seems to be the question for everyone these days, including my shoeshine boy. Calm down. I don't really have a shoeshine boy, although a nice cobbler does occasionally come to our downtown NYC office. He's not a boy, but rather a wise older gentleman who's been walking those cobblestone Wall Street streets longer than I have. And I'll tell you this, when someone with that kind of longevity speaks, I listen. So, do you want to know how I answer that question about the bubble? Well, let's step back. You already know what I say about bubbles because I've been writing about them and posting videos about them for months now. But this morning, I'm going to tell you how I really want to answer that question. The answer that's actually running through my head when people ask it. And that answer is maybe. I don't know. In fact, I don't really care. Repeat. I don't know. I don't care. Go on, let it sink in. Did I shock you? Because I meant to. Am I worried that the market can pull back? Absolutely. And by the way, stocks can't always just go up. So relax. The idea, as always, is to pick investments that will only pull back for the wrong reasons. Good investments, the ones with sound fundamentals, stand the test of time. Now, sometimes a stock that starts out solid loses its way. Management effectively blows it. The story changes and the right move is to get out. And that's fine. That's not failure. That's discipline. Move on because there are other opportunities. You know that. But most people, they still struggle to execute it, even the pros. Here's another secret, one that my longtime readers and viewers have heard me say over and over. Long-term always wins. And guess what? It does. Warren Buffett, the Oracle of Omaha, and his late partner Charlie Munger spent decades preaching the same gospel. They built their empire picking stocks, yet they still told people to invest passively in ETFs and just stay put. Why? Because they know the numbers just like I do. Look, I wrote in our program that looks back at the S&P 500 all the way from the 1920s through today to compare returns across different holding periods, 2 years, 5, 10, 20. And here's what the math screams. The average annualized return barely moves, hovering around 6.5 to like 7%. No matter how long you hold, but the standard deviation, the measure of volatility, it collapses. At 2 years, volatility is 13.7%. At 3, 10.9%. Stretch it to 10 years, 5.2%. By 20 years, only 3.1%. You can see risk shrinking with time. In plain English, you're not giving up return by holding longer. You're just stripping out the chaos. The longer you stay in, the smoother the ride gets. Short-term investors feel every speed bump. Long-term investors glide right over them. Same destination, just different heart rates. Now, take that one step further. Look at the distribution curve of returns. Short holding periods are like a carnival ride. They have fat tails, meaning a lot of room for ugly negative outcomes. But as you move out to 5, 10, 20 years, the curves tighten, the tails thin, and the losses nearly disappear. And the whole distribution shifts to the right. That's a good thing. That's visual proof that time is the only real hedge against volatility. Over 2 years, luck drives your outcome. Over 20, math takes over. Compounding beats luck every single time. If you're a numbers person, let's talk odds. The probability of losing money, that's ending a period with a negative return, starts high and collapses with time. 2 years, 23%. 10 years, around 11%. 20 years, nearly zero probability of a loss. You hear that? Every extra year you hold reduces your risk, not linearly, but exponentially. And that is also a good thing if you don't know. And if you want to see history speak, just check out the timeline of market pain. Each horizontal stripe marks when investors would have lost money for that holding period. Short periods look like a patchwork. Depression, stagflation, dot-com, financial crises. By 10 years, losses thin out. By 20, they almost completely disappear. That's compounding in action. The economy expands, innovation builds, productivity grows, recessions interrupt, but never a race. Time transforms uncertainty into inevitability. When I say long-term always wins, I'm not making a motivational speech. I'm quoting statistics. Investors who stay invested 10 or 20 years almost always win. Every bear market in history has eventually been followed by a new high. That's not optimism. That's just math, stupid. So the next time someone corners you with a question like, are we in a bubble? Don't argue. Just smile and say, bubbles come and go. Time compounds forever. Show them the chart of shrinking volatility. Show them the curves. Show them that chart where the dark patches of loss turn into blank spaces as time extends. That's the proof. I don't time markets. I outlast them. And that, my friends, is how you win. Always. So, your truth bomb for today is this. Time is the only real hedge. Markets reward patience, and long term, it always wins. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.